All right. Good evening. Good evening to everybody who's joined us today. Welcome to our second live webinar for I Find Tax Pros Tax Talk. And today we're talking about equity. And I've got some special guests for us today. And we have a lot to get through. So I just wanted to get through all of the official business and just to welcome everybody. Good morning, wherever you're watching from. And depending on where you watch this, good afternoon and good evening. Our agenda for the day is short intro, and we're going to go into our first speaker, which is John Seeley. I'll tell you a little more about him. He's talking about business lending and debt financing strategies. And then our second segment, we'll hear from Dmitriy Kustov, CPA and MS Tax, and he's talking about the tax implications of equity versus debt financing. Then we're going to open it up to the floor for a Q&A session, and any questions you have, please hold on to them. Drop your comments below, drop your questions below, and we'll be sure to get to them. And we're expecting this session to be 60 minutes, and this is brought to you by I Find Tax Pros Tax Talk. We are a podcast that is available on Spotify as well as YouTube. And every week we're having fresh episodes that we're releasing, speaking on different topics, specifically around tax, but also just business insights to help you with your journey on your business. And check out our latest episode, which is talking about deductions for spouse and employee benefits, what works and what doesn't. And there's an interesting case there of the IRS versus a farming couple that had the farmer and the wife who was working for him. But click, listen on Spotify, watch on YouTube to hear more. Today's objective is we're bringing you 4 clear learning objectives, right? We want you to leave the session understanding the types of financing available for business owners. We also want you to understand the challenges business owners face in securing financing. And Dmitry is also going to talk about understanding the importance of proper debt versus equity classification and commonly used instruments around tax, and then differentiating between debt and equity from a tax perspective. So those are our objectives for today's session. My name is Roxy Bwane. I'm the VP of Platform Operations for I Find Tax Pro. I'm joined by some special guests. My first guest I'm introducing is John Seeley. He's a corporate finance expert from Acreus Capital, and he's a corporate finance expert specializing in securing working capital, managing cash flow, and restoring financial health. Successfully owned and operated numerous businesses. He's an ex-banker, an asset-based lender, extensive network of lenders in his Rolodex, and he helps businesses access the best financing options. He has a BA from James Madison University and an MBA from Georgetown University. Check out his website, check out his LinkedIn below to learn more about him. Welcome, John. Good to have you.
Thanks. Good morning. Thanks, Rox.
Good. Then our second speaker, last but not least, Dmitriy Kustov, CPA, MS Tax, who's also a friend of I Find Tax Pro. He's a certified compliance professional, nearly 30 years in public accounting. He's the founder of Kustov and Associates, which advise businesses in the US and internationally. He's an AICPA tax committee member, helping to shape tax policy compliance standards. He's an author. He has a brilliant startup tax guide, which is a must read, and you can catch that on Amazon. He's a speaker, published tax expert, and trusted advisor in the industry. Check out his website and LinkedIn for more information. And good morning to you, Dmitry.
Thanks for having me. Thanks for intro.
Yeah, so gentlemen, this morning we are going to rely on you to give us all of the ins and outs regarding equity versus debt financing and what businesses need to know. And our first session is going to be taken by good old John on financing for business owners. So I just wanted to welcome you once again, John. Thank you for joining us, and we look forward to hearing what you have for us.
Thanks, Rox, and hello, Dmitry. So going to go through just the different types of funding. A lot of times, business owners come to me and they're like, "Hey, I've got this idea. I've got this product. I've got people interested. What do I do next?" And a lot of times, the first thing we do is like, "Well, is this going to be debt or equity?" Because if it's just an idea that they have, or they're like, "Hey, I have this product, product X, and company X or company Y wants it, but they haven't made it. They need money to make the product." That is going to be any equity. Anything that is really before the sales get going is going to be equity. And a lot of times, if they want to that real beginning startup, the best thing to do is go the equity route with friends and family, which I'll get into. Now, if they have a product and they've got sales and they're like, "Hey, you know what? I've got this revenue and I'm growing like crazy," that's when the debt is really going to step in. So with equity, you got the friends and family money as really the first place that they go. This is where your mom, your dad, ideally are going to step in. They call it a loan, but a lot of times it's a gift. Like, "I believe in you. Let's go. Let's give you the money to get started." Now, if you're further along in the process and you've actually got a company and you're really growing like crazy, and now you want to, let's say, build out a facility to manufacture the product here in the United States or something, a lot of times private equity or venture capital is going to be the way to go. Now, with venture capital and private equity, you're going to have to give up a nice chunk of your company, but it absolutely takes you to that next step and really is oftentimes a rocket launch of success and growth that you would not be able to succeed or encounter with just debt. So with the debt, you have there's different types, right? There's going to be kinds with asset-based financing where what you're going to do is use the assets of the company to then leverage and get financing to grow. Almost by definition, any company that is growing is going to run out of money, because what happens is they grow from X revenue to 2X to 3X, and eventually they're just out of cash because they've got to pay their vendors, they've got to pay their employees. And so what happens is they're like, "Hey, I've got this growth potential, but I'm out of cash." What they'll do is say, "Okay, well, you have accounts receivable, you've got inventory, you've got purchase orders, you have all these things that you've built up in your company." So the lenders are going to step in and say, "Hey, we believe in you. We've seen your track record. Now let's get you the money so that working capital is not going to be your problem to hold you back." And so that way, as you grow, you could grow from 100,000 a month to $1 million a month in revenue. And with the debt lending, they will make sure that you always have the capital you need. The secondary way is bank lending. Now, a lot of times, bank lending is best used for a company that is growing pretty slowly, but growing. They're going to have years of profitability, and that bank lending is often going to be the cheaper financing, but it's going to the company's going to have to show years in the past of success, and especially profitability, whereas asset-based lending doesn't need to even show any years of profitability, just years of growth, and especially projections of growth. Now, an SBA loan, which will, under bank lending, is a really great mixture of the two, because what the SBA lending does is allow the borrower, the business owner, to leverage the assets of the company and maybe personal assets to get what would be cheaper financing that could be used for either growth or expansion. But also it's going to be based on the projections, whereas bank lending, let's call it traditional bank lending, that is going to be looking backwards. SBA lending does look forward at what you're going to do. Now, due diligence is going to be somewhere where the borrower a lot of times that's where they make their mistakes. And I'm sure that Dmitry can attest to the fact that the company financials are the most important part of the due diligence process. And without a good accountant, bookkeeper, etc., a company is going to flounder in this part of the due diligence. A lot of times the business owner, they're wearing a lot of hats. Maybe they're the ones even putting their books together. And the lender wants to know, it doesn't matter if they've grown, if the company's had profit or not. What they want to know is that the financials are absolutely spot on. And so the owner is going to have a good credit score. They're going to need to have the good tax returns, personal returns. But most importantly, the company is going to have to show, I call it the four things: their assets, their debt, their profits, their revenue, and then their profits. These are really shown by the company's financial performance, but also, especially with asset-based lenders, the company's customers' quality is going to be a huge part of the qualification for the company to borrow money. Because if the lender is using that company's assets, a lot of times, especially if the assets are going to be accounts receivable or purchase orders, it's the invoices to whom the invoices are from or to, right? So if the customers are solid, then invoice financing is going to be a strong possibility. And again, we see a lot of drastic increases in revenue with the asset-based lending because the only thing holding it back was the financing. And so a lot of times the borrower comes in and says, I've got these purchase orders, I've got these contracts, I need the money to make them happen. And that's what excites the lenders. But they really need to show that they have a track record of sales, but also they show the professionalism of having strong financials. So what they look at when the lender's looking at these financial statements, it's like, well, where's the money going to come from? What are the assets of the company? Is it going to be the owner's personal assets? Is it going to be the accounts receivable, inventory, machinery, equipment of the company? And what are they going to use it for? If they're going to use it for paying off debt, that's not as exciting, right? That's not really showing growth, unless it's maybe paying off credit card debt or something that is really hurting the bottom line. What really makes them excited is the working capital or even expansion. They want to lend to a company that's going to grow from X dollars to 2X and hopefully pretty rapidly. But then the final question is there enough money that the company's making? A lot of times, especially startups, they just want to get that big deal. They want to get that sale. And they might do it at a small margin, just like, oh, look, we got this deal. And then it's like, well, how are you paying your workers and how are you paying your vendors enough money? How are you making enough money to live on? But most importantly, how are you making enough money that's going to pay back this financing that we're getting for you? So, and this goes back to the financial statements. I had a client that they thought they had a whole bunch of money. They're making great profit because they had $4 million of accounts receivable. Well, when you broke it all down, they had like $4 million of debt. So they, which they had built up because they had been borrowing money because of the cash flow problems. So it turns out that after 3 years, the owner did not even know that they weren't making money because they just saw that money was coming in and look at all this accounts receivable, but they didn't realize that their profit margin was very, very slim, if not zero. And that goes back to the quality of the financial statements. So the challenges for business owners, especially recently, a lot of owners are still suffering from COVID. They had that decline and now they're picking it back up. But especially with banks, what the banks are looking at as well, you lost money 2 years ago, 3 years ago. And even though it's because of a legitimate reason, they're still nervous about lending to companies that have had losses in the past. Whereas asset-based lenders really don't mind as long as there's a legitimate reason for that loss, and how's the recovery been over the last year or two, and what are the projections. Now, one thing that's been happening with the recent political changes that are changing the economy, tariffs has been the number one issue. I recently had a client that had been approved for financing from a bank, and then just about a week ago now, like in February, the banks came back and said, well, with these tariffs, because my client, I apologize, back it up. My client was importing from Asia, and now the bank was like, wait a minute, with these tariffs, they plugged in like a 30% tariff that has not yet gone into effect, to my knowledge. At least it had at that time, but the fear of it, and they said, well, you're not going to be making enough money now with these tariffs, because as we learned from previous tariff increases, the seller in Asia increases the prices. We are the ones that really eat that tariff. It's not like the prices stay the same at X dollars and we still buy it at X dollars and now there's a tariff that they pay. They increase the price of the product, so the American company pays that X plus the tariff. So, and then so the bank was like, even though it hasn't been in effect yet, the bank was like, well, we don't know what's going to happen. So the bank rejected my client at the last minute purely because of these tariffs and the unknown about that. And so then, because of what's going on, it's the unknown that the banks are most scared of, right? As we're talking about with like the government saying this, that, I think at one point the banks were not allowed to like really receive money from Chinese companies for a while because of that unknown, and the government was like, hey, they're stepping in. And again, I'm not trying to make this political at all. It's just a fact of the
reality,
right? That's coming in, and so what's happening is that a lot of these companies that import from Asia are being second guessed or given a second look, but not in a favorable way because of the fears of these unknown directives that are coming. But again, the biggest challenge, as I spoke about earlier, has been the professionally prepared financial statements. Another recent client I had, we're looking at the financials, and it's like, wait a minute, where's your accounts receivable? And they're like, and they had this excuse that, well, it's kind of an inventory. And it was like, well, where is it? Well, we have a separate tracking over here. It's not on the financial statement. And it's like, no, you need your financial statements prepared. And again, this is where Dmitriy and his group really could step in and say, and get it professional so that the bank or any lender that looks at it can't be having those questions. They can question, how come you're not profitable? That's fine. But if they question, where's the money here and why is it all confusing and this, it's that reason that another client got turned down, and they said, look, go get professionally prepared from a CPA, get those financial statements, and let's wait 2 quarters, 6 months, and see how you're doing, and make sure that we have 2 quarters of CPA prepared financial statements. And again, it's because the business owner, oftentimes they're doing it, they're using QuickBooks or something, which is nothing against the service, but they're doing it on their own, and they're not they're saving money by not having a professional bookkeeper or accountant, and that's where they really fall into a quagmire. So just to summarize,
can I ask you a quick question? What do you usually see the level of assurance from a CPA for a loan? A typical loan. Do they require audited statements, or as far as you can see, it's okay if it's just compiled or
great
reviewed?
question. Right now, for the size of, let's say a few million, and this is why I'm more talking about the startup for this part, you know, but if it's reviewed or compiled by the CPA, that's going to be good enough. When we get into if there's a quagmire like this one, they might want this one audited just because at this point they've already shown their hand. So at least this bank would probably require audited, whereas if we go to another bank, we'll have compiled or reviewed. But mostly, especially right now, considering the mess of this exact client, compiled is going to make it better. Especially for me, I as a consultant, I want to have faith that these financials are solid, and so I know that the lender is going to want to make sure that that's the case. But when CPA has its stamp of approval on it, that's going to be huge deal for the client. Yeah.
And John, I think a key thing with lending is risk profile. Can you just maybe shed a bit of light on the different stages in the company and the risk that inherently come with each stage and the type of funding that you would get access to based on the stage you are and the risk that each stage presents?
The number one risk for any lender is fraud. And so a lot of times what really comes in is checking out the owner and what has the owner done, and what are how good are the customers and how good are the contracts. And by that I mean, like, if the owner has a house with equity that they're like, I will put this on the line, then that speaks volumes to the lender. Not that they want the house, not that they want to take over that, but it speaks volumes that the owner has faith in their company. And then, they have, documents that they sign that says, like, we will not commit fraud. Because one thing, I can't believe it, but a lot of times what a customer will do, a borrower, and again, when I say a lot of times, the number one fraud is submitting invoices that aren't actual invoices. They will say that, Acme company is buying, X widgets, and the lender will lend money on that invoice. And then it turns out that they didn't sell widgets to that company. And a lot of times the borrower is doing it to try to, it's kind of like they think that, if I get this money and I fix this problem, I will repay that. Like, they're not doing it to get the money and run away. They're doing it because they're like, oh geez, I'm in a hole. I got to pay my
then survival mode.
Right. And then it starts exasperating, right? It's like someone going to the casino and it's like, well, if I just double down, right, I'll get my money back and I'll be good to go. And it just exacerbates the problem. And so the lender was going to look at that. And also the lender is going to look at how many times have you been selling this product? So if the the borrower has not really been selling this product, then the lender is going to be like, well, let's wait until you have a few sales and they can show that they've got sales and they've received payment for that. Because a lot of times they're like, hey, this is my first time selling these widgets, and I have this invoice. Well, we don't know if the company is going to like the widgets because if there's no previous sales. We don't know if maybe the company is going to just return the widgets because they don't like them. Because if the lender advances on the invoice, and then the company, the borrower's customer says, you know what, I don't like these widgets, and returns them, then the lender needs to get their money back somehow. And it's not going to come from, the borrower is not going to readily return that money. So did I answer the concerns to your satisfaction?
Yeah, I think you did, John. I think the key thing is understanding the risk that you present as a lender or as a borrower to the lender. And I think that's critical. But maybe a more pointed question is, where do you fit into the ecosystem, and what do you provide to business owners that is different from direct lenders? So, for example, why should they call you instead of just going to the bank for financing?
Great question. A lot of times my clients have gone to the bank and the bank has said no. And so then the bankers call me and say, hey, John, we weren't able to help these people. But, the reason to come to me is that I know all the bankers and the lenders, and I know them throughout the country. And what I do is I work on behalf of the borrower. So I'm not trying to pitch my deal. I'm compiling the deal, their deal, and sending it to bankers and lenders at the same time. So concurrently, we're getting offers in from all over so that we really see what the market is going to provide. So if no bankers want it, that's the market's showing that no bankers want it. I had one prospect come to me. They had gone to 13 bankers. And it's like, you would think after 3, they might have learned their lesson, right? But they went to 13. So what I bring to the table is a one-stop shop. I take it off the table. A lot of these business owners, they're wearing more than one hat, as I mentioned before. They need to focus on growing their company. They can't deal with calling out to 10 different lenders, filling out 10 different applications and whatnot, submitting all this, and then tracking where it's all, who they're having conversation with, et cetera. I can do all that for them. And kind of get into one of your questions that what in my write-up, I have 3 points. I call it the good, the bad, the ugly. I say, here's what's good about this company. Here's what's bad. And here's what's ugly, right? Like what is it that, if you're going to say, I don't do this, like, for example, and ugly is like cannabis. Some lenders don't like cannabis at all. Some people don't like construction. Some people don't like certain things where, like, there's that, right? Maybe it's they've lost money. They lost $2 million last year, right? And then after I go the good, the bad, the ugly, one of the things is that then I have, here are the mitigating circumstances of the good, right? Which is they're growing. Here's their projections. Here's bona fide contracts that they have from their customers that show what they're selling and how much they're selling it for over the next 6 to 12 months. So I try to, in a 1-page executive summary, I make it so that the lenders look at, here's a nice summary of the good, the bad, the ugly. Do I want to even go further with this? And so my lenders, they like getting an email from me because they only have to spend a few minutes to see if they're going to spend more time, right? But then I've packaged up the deal. I'm like, here's these financial statements, the ones I mentioned before. Here's these, right? Including the bank statements. Now, this backs up my summary. Now, are you interested, right? So this way, my lenders can go through and quickly discern whether they like it or not, and they get back to me quickly. And again, I'm able to send it to 30, 40 different. I had one deal. I did send it to 40 different lenders. I got one. You only need one, but I got him a great deal, and I got him $13 million. And a lot of it this was during COVID, and a lot of banks and lenders had pulled back during COVID. So, for me, I sent it to 40 lenders. No business owner wants to send it to 40 lenders, right? But also what I'm able to do, I work with the lenders and get the best deal possible. So if Acme calls, Wells Fargo and says, hey, I want some money, or another lender, they're just a one-off for that bank or that lender. Whereas I'm dealing with them and I'm talking to oftentimes the credit officer, and I'm like, okay, can't you do better than that? Right. Here's what's going on. And I oftentimes bring from the offer to the final, it comes down, in almost every case, it's come down more than what my fee is. And I charge just a few points on the success of it. And I don't get paid unless they get the money. So my clients don't have to worry about, you know what, man, I paid all this money and I'm not sure if I'm going to get it. I'm on their side. So they know that I don't earn anything until they get the money from the lender. So,
right. Wonderful, John. And just in summary, what is the lending market looking like? Is there light at the end of the tunnel? What is the current climate?
Right. The banks, I feel, are not very eager to put money out, at least not this year. And the thing with banks is they have all these borrowers now that they're actually now spending all their time going to these borrowers and saying, hey, how is everything going? Are you okay? You know, and checking in on them and not putting out new money until this, are there going to be tariffs? Yes, no. Like, how much is the tariffs going to be? And not just the tariffs, but other aspects. And so the banks are going to be really tough for at least the next year. Lenders are actually even busier, which makes it a little tougher to get the attention of the lender, because they're like, a lot of them are moving up. Like, instead of doing like, 5 million, now they might be like, you know what, we won't really want nothing less than $10 million, because the banks are saying no. So it's increasing the demand for the other alternative lenders. So the money is out there, though. The lenders that I deal with, they have money, they are lending. And if a company has growth, regardless of their past, if they're showing growth and their projections show really taking off, it's absolutely a good market for alternative lending.
Yeah. Wonderful. I think that's a nice summary of the lending market, John. And obviously, we would love to unpack more. And time is obviously a challenge. We've gone through the questions, but if anybody wants to contact you, John, where are you reachable? Who should contact you? What should they contact you for?
Yeah, any company that's growing, is our ideal. The best is the B2B businesses that are selling, and somehow, like, a lot of times you see it really take off in a slow, it kind of goes like this, and all of a sudden it's like word of mouth spreads. And again, I had a flooring company that went from 100,000 a month to $1 million a month within a year. That's some serious growth, and their only thing that was holding them back was the financing. And the owner, multimillionaire, he had put in $4 million of his own money, and then he's like, all right, now I'm out. Right. Like I said, any company who's growing is going to run out of cash, just because his accounts receivable became about $4 million, right? And that's just the accounts receivable. Then he's putting money into inventory, which was about $3 to $4 million. So the company had 15 million of assets, and that's money that's tied up. And so we were able to get him financing, both trade finance and inventory financing and accounts receivable financing, 3 different types of financing that we were able to provide for him as he was growing. So a company that's really growing and saying, oh my gosh, the only thing holding me back is money, that is a great person to call.
Perfect, John. So you work with everything from startups to established growing businesses.
Right. I had one client that they had an order from a pet conglomerate, and they had the purchase order, and I was able to get them the purchase order financing, which then also turned into accounts receivable financing. And they grew, and they became, within 3 years, they became a 12 million in revenue for the year from the first order that I helped them get financing for. So that was one of the ones I really liked, meeting these people. I'm meeting the people, like, I'm dealing with a man or woman that started the company, they're growing the company, and to watch them grow, like, I'm not just helping someone get rich quick or something. I'm helping a company that, and a business owner that's like, just a regular Joe Schmo, so to speak. and there's just watch him take off, and it really is pleasant to watch him grow so fast. Especially when they're calling, I just need the money. I got all this potential. And so, yeah, as long as they're growing and anywhere in the country, any industry, we can help with construction, medical, and cannabis, which are the three tough ones. And I've had clients out to New Hampshire, Hawaii, Florida, and Alaska. I had one. It was a flight company. It was an air hospital, anyways, hospital in Alaska. So anywhere in the country, and I can go as high as There's no limit because I have lenders that do 50 million. I have lenders that do 1 million, and the 50 million lender does not deal with $1 million deals, and the $1 million lender does not deal with 50. But that's why I like being a consultant, because if you need 20, I've got these lenders. If you need 2, I've got these lenders.
Fantastic. Well, John, that was very enriching. I think there's a lot to unpack there, but just remember, contact John if you need more information and a bit of hand holding if you're raising funds at the moment. Reach out to John and Acquiesce Capital. Details are on the screen, and also you can drop us an email at info@iFindTaxPro if you need us to send you this information. So, John, thank you. That was enriching.
Thank you, Rox.
Yeah, wonderful.
Amazing. Thank you, John. It's interesting how you commented on tariffs, and of course, again, not to get into too much politics. I think the attempt of solving all the problems as one hit, it's definitely going to backfire. Even before they put it in place, banks that usually look ahead, they're telling us, okay, that may not work right there.
Right.
Amazing. So and there we go. So I think there is probably no way to get rid of income tax, and therefore we should be looking at it. Still, probably not going to go away anytime soon. So it great. And also, it's amazing when you started your presentation, you were distinguishing very clearly equity and debt. And you were saying that anything before sales is equity. And moms and dads can call it a loan, but it's really the equity, right? And this is exactly the tax position on all of that. It's exactly the tax seem to be following, the bank's principle, the economics. They, you can call it whatever you want to call it, but at the end of the day, we're going to test it and see what it really is and what circumstances are. Rox, if you can move forward, I think you have my
Yeah, so Dmitry, welcome. Floor is yours, my friend. Let's look at the tax vantage point of equity versus
that's
debt.
Right. Yeah. Okay, awesome. Thank you. Yeah, and as we're saying, it's the debt involves a creditor legally entitled to repayment of principal and interest, regardless of company profitability. So it definitely so there is this one. Okay, so the debt versus equity question, arose pretty much more than 80 years ago, and it's a well-known issue, which is in some way a cornerstone of the U.S. taxation, because it's important for U.S. tax purposes what instrument is classified as. Equity, as opposed to that, of course, it means when the holder is effectively an owner whose return depends entirely on the success and profitability of business. And again, the name of the instrument doesn't control at all. It helps a little. It's one of the factors, but it doesn't control. That's what's important to hear. To remember. So can we go to the next slide now? Now, why does it matter? If we say it's an important question for taxation, but why? And here are two big reasons. If it's a loan, then payments, the interest payments that are made on the loan are tax deductible. And if it's an equity, then these coupon or little payments, they will be called dividends, and dividends are not tax deductible. So, not being tax deductible means that, let's say, a corporation has to pay tax on it, and also the individual who receiving these payments also has to pay tax on it. So there is this double taxation issue. So to avoid this double taxation issue, usually companies and beneficiaries usually they prefer the interest treatment. Okay, so with some exceptions, of course, interest is taxed at a higher rate as dividends. Sometimes, for that reason, actually, dividends might be preferred in some cases. So it gets a little complicated, but that's where it comes in. And another point here, when investing in startups, especially pre-revenue, even if an instrument is called a loan or some other type of instrument that we will look at, it will be the last slide. We're going to go over popular types of instruments for startups. It could be, at the end of the day, considered equity, and that could actually help the investor because there are some important preferential tax treatments for investments in early stage entities. Okay, I mean corporations mostly. Um, so and that yeah. So okay, let's go to next slide. So here's here are a couple of examples of two more cases. In Kraft Foods, it's an older case, 1956. They had an interesting situation that went through several courts where a subsidiary owed to parent money, and the question was it real investment by the parent in equity of the subsidiary, or was it a loan? And few courts look at it, and finally the last court said that yes, it's going to be treated as a loan. So, which means that the relationship between the parties is not always controlling. You could obviously say, well, they just gave the money because they wanted to invest in an entity, but after taking various facts into consideration, the courts finally decided that no, it's okay, it's okay, legitimate loan. Now, relatively recent court case, 2012, as you can appreciate, because it's only 13 years ago, and some of the cases we're looking at 40, 50, and this is only 13. And there, the case and situation is extremely complicated. It involves international tax planning, agreement with Netherlands about preferential tax treatment. There was a lot going on that. And what was interesting, the instrument that in question, it was hybrid loan and equity. So from the point of view of one country, it was considered equity. And from the point of another country, it was considered a loan. So I think for US, they were trying to treat it as a debt. At the end of the day, they were rejected. It was considered equity, and important factors again. There were there were a few factors, and some of them the enforceability of it. So when a party couldn't pay, the other party didn't really enforce it. They instead accepted more debt from that party. So And at that point, court looked at it and said, no, but it looks like it's just an equity, and they simply increasing their stake in the venture. Those are examples that important. Okay, so let's go to the next slide. And so, in very general way, an overall approach may be summarized as follows: uniqueness. So each financial arrangement is unique. So that's important to remember. There is no clear cut. We will look in the next slides that they're trying to come up with precise rules, but in fact, it's not possible clearly, because there are so many possible arrangements that are available. And when there are large dollar amount, just like what John was saying, you need an audit when you have a large dollar amount. By the same token, when we're talking about bigger business, so IRS looks at it more carefully, and it very often makes its way to courts. And that's what we have, this amazing opportunity to see what the logic behind these classifications is. So that's and so the courts analyze the totality of economic substance. So they look at all the details, and none of them is controlling necessarily. Of course, related party transactions, such as parents' subsidiary, are typically scrutinized more. Okay, so that's what the approach is. Now, if we can go to the next slide. So the Congress, it attempted to codify the rules, but essentially it failed. It was in 1969. They issued this code. They promulgated the law, Code Section 385, and they basically said IRS has the authority to distinguish between stock and debt. They just gave it to the IRS, and guess what? A few years later, IRS came back with their ruling, a regulation that is, and they basically say that determination should be under the common law principles in accordance with the factors prescribed by it. So that's basically saying that the court's precedents will sort of decide. And again, going back to the same idea that we just have to look at every single arrangement. I find it fascinating. Darius was asked, okay, guys, you can tell us what you want to do. And they just say, well, we don't know because it's too complicated. So it's an interesting question. Let's go to the next slide, Rex. Thank you so much. Okay, so here, even though the Congress told the IRS, you guys go ahead and figure out what the law is, they did suggest specific factors that are relevant. And here they are. So what's very relevant when you sign an agreement and you want to treat it as a law? What's relevant here, number one, in all the circumstances, is there a certain sum of money that needs to be paid by a fixed date with interest? Super important. And whether such promise is actually enforced by the note holders matters as well. So let's say if the note holder doesn't try to collect the note when it comes due, then it looks more like it was an equity, right, rather than that. So that's it's not only how a document is created, but also what kind of actions the note holders undertake. Okay. Then a priority of subordination. So if you subordinate your debt to other lenders, that means you're putting yourself in the position of other owners. You're putting yourself very close to the position of other, like the equity holders. So therefore, it seems to be a little more closer to equity. Then ratio, how thinly entity is capitalized? What is the ratio between your equity that you have in the company and the debt? And of course, here, we sort of need to also maybe ask advice from John and professionals like himself to see by industry what sort of ratio of debt to equity is appropriate for this or that industry. It's because that's all looked at those individual industry levels, not all one size fits all, definitely not. Then another important factor, whether the instrument is convertible into corporate stock. So it's very relevant in the context of startups with the convertible notes, obviously. If there's convertible notes are always a suspect of being an equity. So, if you want to make them otherwise, you have to follow the steps, including enforcing collection of convertible notes. Last but not the least, the relationship between the holder's stock ownership and their holding of interest in question. Right. So again, if it's a related party, like John was saying, right? If it's mom, pop, or brother, sister, so as well as if there is a direct ownership, not necessarily as we saw in one of the cases in Kraft, but possibly it takes a little more scrutiny of their relationship. Okay, so those are important factors. Can we go to the next slide? But there is one important thing that this code section gave us, and it gave us a way to reconcile between the lender and the borrower. The issuer or the borrower, their original classification of the instrument is generally binding. So in other words, if a company borrows money and they issue what we have usually 1099 interest every year or 1099 OID every year to the lender, well, they made their choice. They simply announced that we're treating it as a debt. And unless the lender has a very strong case and very strong other ideas, they're pretty much going to be bound on how the borrower treats it. So maybe because of this potential controversy between lender and the borrower, perhaps some of the arrangements that call themselves loans, maybe they should be written up in advance, an agreement that we're going to treat it as an equity or we're going to treat it as a loan, so that parties are not inside a controversy of what to do with that. Okay, let's go to the next slide. Despite the fact that IRS did not issue regulations, it did issue notice. And the notice is something that is usually done before regulation is issued. So they sort of looked at it again and they say, okay, we understand what the Congress wants us to do. Here's some important red flags and a couple more additional points that we think are important. Let us put it in the notice. And this is what they say. If instrument is repayable in stock, or if instrument is with an extremely long or indefinite maturity, well, those are two red flags for the IRS. And this notice is still out there, so this is valid notice. And of course, there are other things. Some of them repeat what we just looked at, which is unconditional promise to pay, fixed proximate maturity date. So we cannot say it's going to be 15 years from now. So it has to be within 3-5 years, maybe 6. Right to enforce the payment, subordination of rights to general creditors, just also talked about it, right to participate in the management of the issuer. So if you give a convertible note and sit on the board of a company, maybe it looks a little bit closer to accuracy, perhaps. Think capitalization, just discussed it. Identity between holder of instruments and stockholders or of the issuers, either they're related or the same parties. The label, of course, label is always important, but it's not controlling. And another one, treatment of instrument for non-tax purposes. How do you report it on the how do you report it to lenders? Do you tell lenders that this is just my equity investors, or you tell them, well, no, I have other lenders, and you're going to be one of them. So that's all very, very important. Let's go to the next slide. Let's go to the next slide. Okay, and finally, I thought it would be amazing to quickly go over specific instruments, some specific instruments that are popular when raising raising money outside of actual stock purchase. So SAFE, I think, very popular, simple agreement for future equity. It has no interest, has no maturity, and usually considered equity. Convertible note, so that can have a range. It usually includes interest and maturity date, but depending on who is lending whom and whether or not they're in forced collection and whether or not it's secured, it can go both ways. It can go like a loan or equity. Keys, keep it simple equity is a hybrid loan equity instrument. Usually they have two types. They have purely equity and they have purely loan. But you can attempt to make it loan, but as I said, the terms are not enough. So behavior and who the parties are important. Then payment and kind notes. So that's when the interest payment, it capitalizes in principal amount basically. So you don't pay, you maybe increase your conversion later into equity, perhaps, or maybe later you get more money. So it's risk. In my opinion, it's risky of being treated as equity. In one of the cases, for this Pepsi case that we had, they had this arrangement that they called baby bonds when payment couldn't be made in cash. They simply said, okay, we'll just take an extra loan. So that wasn't considered the proper loan. I mean, debt. RBF, revenue-based financing notes. It's a portion of revenues goes to investors until required multiples are repaid. This, I would say, neither debt nor equity. It's entirely different type of arrangement. We can maybe get into it for some other time. I'll just have it a little suspenseful, but I don't think it could qualify as either loan or equity properly. And finally, perpetual bonds. Apparently, there is such thing as perpetual bonds when the interest is paid indefinitely. And to me, it looks more like equity. But, John, have you ever seen such arrangements? Have you ever seen in your practice perpetual bond?
No, not outside, not within the banks and lenders. Like
Yeah.
I've seen people do friends and family perpetual bonds where here's a bunch of money and just pay me $1,000 a month for indefinitely.
Yeah. Okay. See, I think if someone is going to look at this arrangement, I think they might say, okay, maybe after 5 years it becomes equity. If you're not going to take it back, perhaps. And that was it. I'm done with my part, guys.
And another question, Dmitry, because I think when lending money, many of us don't think about the tax implications, right? And generally, what's more efficient from a tax planning perspective in terms of instruments?
Most efficient? It depends. You see, it depends. If you're talking to an investor, usually investors would be much happier if their investment considered all equity. But equity is not always available in early rounds. So they have to make things up and say, okay, this convertible note. And of course, they would also like to have some interest. while it's being equity. So that's their interest. From the company point of view, they normally would like to get a tax deduction, and that would be more coherent with a loan treatment, okay, on interest payment tax deduction, that is. So there isn't, it's a little, that's why this 385C, that's why they have the specific rule. They give more weight to the treatment of the borrower. They say, okay, you're the borrower, you're going to carry this, you get to decide first. And then the lender is say, okay, if you really have strong argument, you can write to us and explain it. So it's one of the requirements. You have to write to the IRS and say, okay, they think it's a loan, I don't think it's a loan, here's why. And that's how things can be done. And in practice, we have done a few things that were of similar nature when we took positions that are contrary to what the instrument says. But again, under certain circumstances, it was justified, as I think. And, it was approved by the IRS, so that was good.
Wow, fantastic, fantastic. I think that was very enriching, Dmitry. And we just want to also get some clarity on just how people can contact you, what they can contact you for, what you can walk them through, because we really want to make that that available for our listeners.
Yeah, absolutely. Very happy to talk to anyone who would like to have more guidance about loans, equity, or anything else that has to do with tax and accounting. We're a full service CPA firm. We do everything from bookkeeping, tax return preparation, dealing with the IRS on various issues, attest services, compilations, reviews, audits. We were specializing, of course, in small to medium-sized businesses. United States international, we do a lot of international work, structuring as well as compliance work, complicated compliance. International from the U.S. point of view. We don't file any other country's taxes, just from the U.S. Inbound people that would like to do business in the United States, as well as U.S. people that go into business in other countries. So we have, I have almost 30 years experience. This company has been, I think, for 22 years. I have this firm, and so happy to help anyone who would like to.
Yeah, and just as a quick reminder, is the importance of having properly prepared financials for any business owner that's trying to raise capital, trying to contact a John or Acris Capital. Contact a CPA first, make sure that your finances are in order and you have the right financials prepared. And that's just a little reminder for all of our viewers today. But I think overall, it was a very enriching session, gentlemen. Any last words, anything that you want to add before we call it?
No, just if you're going to call me, make sure you call Dmitry too, because I'm going to need good financial statements, and Dmitry can make that happen.
Yes, and absolutely, happy. And if you need money, of course, we're going to call John for. I'm actually amazed. John, hats off, because I just know when I get my mortgage financing, it should be easier, but that's crazy. But I can imagine what you have to go do with when you do the business, when you don't have an asset that's sitting right there and you can counterclaim it.
Right.
It's what Trax was saying. How do you believe this person? What do you do?
Right.
That's always a challenge. So amazing.
So that's why if I don't believe in my client, my lenders won't. So they got to get through me first,
Yes.
I stop people. I'm like, no. I will not show your deal to. I've talked out of business. Like, I've declined business because I don't have faith in the potential borrower.
Yeah,
which is a great service, John, because you save people a lot of time and heartache. Because as you spoke, as one of your one of the anecdotes of a client that came to you after contacting a few dozen or banks, right? That you I think what's important with having people like you in the ecosystem is firstly the education and the hand holding of what's the right direction and what is best for me. So I definitely endorse people calling middlemen
and
between
if
the funders.
Dmitri's put together the financial statements, that's endorsement, right? Like, so I have faith in the financial statements if they've come from Dmitry, and my lenders have faith in my client because it's come from me. So it's that teamwork,
together.
Make sure that
Absolutely,
it's all on the up and up.
Yeah,
right. That's fantastic. And just one final question that I had is that, especially from a lot of our audience is people who are in the tech space, SaaS product, and what are the kind of vehicles that you have, or the funding models for people that actually do have revenue, right, and do have a pipeline. But I think the challenge with technology product is you're banking on future revenue, but you need the revenue today to invest in whatever it may be, right? Can you just the final anecdote on what's your approach in scenarios like that?
Sure. If the company, they sign up a client that's going to pay them monthly for the next year, but they want that money, let's say it's $1 million and they want it now. Well, they needed to pay, their own vendors and employees. What my lenders look at is how solid is the first of all, how solid is the borrower, right? Is this their first customer? Do they have a bunch of customers? Number two, how solid is that customer that has the technology that's paying that monthly fee? And number three, can the borrower stop that service from being used by the company if the company doesn't pay them, right? So if it's an important technology that the customer is using and it's a solid contract, then the lenders will look at it and they will usually lend up to anywhere from 3 to 4, maybe more, but usually around 4 months of revenue that's upcoming.
Your pipeline, right?
Right. So so they'll put out $1 million contract for the year. They can lend up to $400,000, for which that the borrower is probably going to then pay off all their people that they use, because a lot of times the borrower is not incurring many costs for that service. They've spent all their money already, and so that $400,000 gives them a nice reprieve. Okay, we paid all our bills, and now everything else is profit coming in for the most part. But it's definitely important that that's a solid customer, a solid contract, and that technology is both important and retrievable, and you can instantly stop that company from using that service, so that they have to keep paying. You need them to have to keep paying.
Right. So I think the summary is the name of the game is risk. The less risk there is, the easier it is to get money from other people. OPM, other people's money.
Yep.
Right. So,
and I strongly recommend, a lot of people, they're like, well, I don't want to borrow money. It's like, if you borrow X dollars and your revenue as a direct result will shoot up, there's no reason not to. And I actually created a spreadsheet showing, okay, here's what your expectations are without money and with money, because a lot of times they're like, oh, I don't want to have to pay, $50,000 in interest. And if I show them according to their numbers that their net income is going to go up $200,000, then it's like, I'd pay 50 cents to get $2 all day long, right? Like, they fear the interest expense without taking into account like what it's going to mean to their bottom line, and then they're like, okay, yeah, it's worth it. It takes money to make money, and it's worth it. And sometimes I've turned down clients when I'm like, well, what is this going to do? And they're like, well, it's just nice to have. And I'm like, you don't want just nice to have money. You want money that with this dollar, I'm going to turn this dollar into at least $1.50, $2. Absolutely. Right. So
fantastic. And John, I hope you'll be willing to share that spreadsheet, right? And for anyone who's watching this, do email us on info@ifindtaxpro.com if you'd like a copy of this presentation with all the notes and any of the cheat sheets that John and Dmitry may have for you. But gentlemen, I think that is all the time that we had. I really appreciate this exchange. It was very enriching. I think everybody has your contact details, and I just want to thank you again for taking the time, and just want to encourage everybody to follow us on iFind Tax Pro. We're at iFind Tax Pro on all the major platforms. Please comment, like, and subscribe to this episode. Thank you for joining us, and thank you, gentlemen, for adding value.
Thank you both. Appreciate y'all.
Thank you, John. Thank you for us. Bye.
Yes. Cheers.